Is housing relief really coming to King County, or are we waiting for something that isn't? Over the past year, we've had more buyers ask us the same question in different ways. Is housing relief coming to King County, or is this just the new normal? Between population growth and rents that continue to rise, it's a fair concern. Today, we want to walk through what's actually driving housing pressure in Washington, how these forces interact, and what buyers should realistically expect moving forward. Right now, the market feels mixed. Sales activity has slowed in some areas, interest rates remain elevated, yet rents are still rising. That can feel contradictory. But once you understand how these forces connect, the picture becomes much clearer and much less emotional. Housing pressure in Washington isn't coming from one single cause. It's several forces stacking together. First, population growth. King County continues to attract households, and that steady growth increases demand for both rental and owner-occupied housing. More households competing for limited housing keeps pressure in place. Second, borrowing costs. Elevated interest rates reduce purchasing power and slow new construction. Builders become cautious. Buyers face higher monthly payments. When demand grows but supply doesn't keep pace, pressure builds across the entire system. Interest rates impact every market, but higher cost areas like King County feel it more quickly. When rates rise, monthly payments increase significantly. That often pushes some buyers to delay purchasing. But here's the important part. When buyers delay, many remain renters, which increases rental demand. This is one of the most common questions we hear. If home sales slow, shouldn't rents fall too? Not necessarily. When households delay buying because of interest rates, they compete longer in the rental market. If rental supply doesn't expand fast enough, rents can continue climbing, even if sales activity softens. It's not a contradiction. It's a shift in where demand shows up. Population growth increases demand on both sides, rental and ownership. If housing production doesn't keep up, pressure becomes persistent rather than temporary. That's why affordability challenges in King County tend to last longer than a single cycle. Housing supply takes time to adjust. When people hear relief, they often imagine a dramatic price drop. In reality, relief usually looks like rent growth slowing, inventory stabilizing, price increases leveling out. It's gradual. Policy changes, zoning updates, and increased housing production can help, but these shifts take years to materially change conditions. Housing markets adjust slowly. Instead of asking, when will everything drop, a better question might be, how long do I plan to stay? How much are rents likely to rise over that time? How does owning fit into my long-term financial picture? Looking at long-term stability often provides more clarity than waiting for ideal timing. We monitor population trends, rental activity, and inventory movement across King County on an ongoing basis. Housing relief is possible, but it's far more likely to be gradual than immediate. Planning for persistence tends to be more effective than waiting for a sharp correction. Clear expectations matter more than reacting to headlines. If you're weighing high interest rates, rising rents, and long-term housing costs, we're here to help you think it through. No pressure, just clear, local guidance.